Look, if you're over the age of 70 or you've got parents in that age bracket, I need you to stop whatever you're doing and listen very closely. There is a specific piece of paper, a check, that might arrive in your mail this year. It could be from the sale of that downsized home, a cashed-out annuity, or even an old 401k rollover. You take that check, you walk into your local Chase or Bank of America branch, and the teller gives you a smile. They hand you a receipt. You walk out of those sliding glass doors and you feel completely, 100% financially secure. You think, hey, I paid my standard taxes on this. I'm in the clear. But let me be real with you. You are entirely wrong. The very second that check clears your personal checking account, you don't know it yet, but you have just tripped a silent multi-agency wiretap between the IRS and the Social Security Administration. Make sense? You haven't just made a deposit. You've triggered a synchronized multi-year chain reaction designed to claw back your Social Security benefits, triple your Medicare premiums, and slap you with a 25% penalty on your own retirement savings. And here's the crazy part. They don't send you a warning. They don't call you to double-check. They simply wait. And when the trap finally snaps shut 2 years later, it is mathematically devastating. Welcome to the masterclass. Today, I am going to expose exactly how this systemic trap works, the obscure tax codes they are using against you, and the precise, step-by-step master rescue plan you must use to protect your money. To understand how brutal this system is, you need to see it in action. Let me tell you about Eleanor. Eleanor is 73 years old, a hard-working middle-class retiree living on a fixed income, a modest Social Security check. Like many seniors, Eleanor decided she needed to simplify her life. She sold a small duplex she had owned for decades. After closing costs, she walked away with a check for $120,000. She did exactly what 99% of Americans would do. She deposited the check into her personal bank account. Eleanor is a law-abiding citizen. She handed her paperwork to a tax guy and paid her capital gains tax. She breathed a sigh of relief. The money was sitting safely in her account. She thought the transaction was over. It wasn't over. It was incubating. Fast forward exactly 2 years. Eleanor is now 75. She goes to the mailbox and opens her annual statement from the Social Security Administration. Suddenly, her monthly Social Security benefit, the money she relies on to buy groceries, has dropped by nearly $300 a month. She thinks it's a clerical error. She calls the SSA, waits on hold for 2 hours, only to be told by a cold federal representative that there is no mistake. Her benefits were automatically garnished to pay for massive surcharges. In a total panic with her monthly income slashed, Eleanor realizes she can't pay her property taxes. So she makes her second fatal mistake. She logs into her traditional IRA and takes an emergency withdrawal of $20,000. By doing that, Eleanor just poured gasoline on a financial fire. She just triggered the Secure Act 2.0 excise tax penalty. In the span of 36 months, a single, innocent deposit structurally dismantled her entire retirement. How did this happen? Let's break down the law. Here is the systemic truth the financial industry rarely explains. The IRS and the Social Security Administration do not look at your wealth. They look at a number called MAGI. MAGI stands for your Modified Adjusted Gross Income. When Eleanor deposited that $120,000 check, it spiked her MAGI for that specific tax year. Now you might say, well, she paid the tax, so what's the problem? The problem is a silent killer hidden in IRS Notice 703. It is called the Provisional Income Formula. Most seniors falsely believe that Social Security is completely tax-free. Let me tell you right now, that is a myth. The IRS uses a formula to decide how much of your Social Security they are going to tax. They take half of your annual benefits and add it to all of your other income, including that massive check you just deposited. Listen closely to the thresholds, because they haven't been adjusted for inflation since the 1980s. If you're single and your provisional income crosses $34,000, suddenly, up to 85% of your Social Security becomes taxable. 85%. By simply depositing that check, Eleanor artificially pushed her income past the threshold. She didn't just pay tax on the house, She accidentally volunteered to let the federal government tax her Social Security. That was domino number one. But wait, because the IRS wasn't done with Eleanor yet. Not even close. You see, domino number one was just the warm-up. Now we move into domino number two, which is something I call the two-year ghost. In the professional world, it's formally known as IRMAA, the Income-Related Monthly Adjustment Amount. You need to understand that the Medicare system and the IRS are constantly talking behind your back, but they are operating on a two-year lag. This is where the trap gets truly sinister. The Medicare premiums you pay right now in this current year are actually based on the tax return you filed exactly 2 years ago. Most people have no clue about this. When Eleanor turned 75, the Social Security Administration looked back at her tax return from when she was 73, the exact year she deposited that house sale check. They saw her artificially inflated MAGI and instantly labeled her. They didn't see a sweet grandmother who just sold a duplex. They saw a high-income earner who needed to pay her fair share. And here's the crazy part. IRMAA doesn't just increase your premiums. It's a cliff. If you go over their arbitrary income bracket by even one single dollar, your Medicare Part B and prescription drug coverage premiums skyrocket. We are talking about hundreds of dollars a month in extra surcharges. And here's the most aggressive part of the entire system. They don't send you a bill in the mail and politely ask you to pay it. No, that's not how the federal government operates these days. By federal law, they directly garnish that money from your Social Security check before it ever hits your bank account. That is why Eleanor woke up one morning to find her monthly income had been severely shrunken. It's like a ghost from your past coming back to haunt your bank account 2 years later. You've already spent the money from the house sale, but the government is just now showing up to collect. Now we reach domino number 3. This is where Eleanor, and maybe you, if you aren't careful, enters the panic zone. Eleanor was bleeding cash. Her monthly checks were smaller. Her bills were staying the same. She needed money just to survive, so she did what seemed logical. She logged into her traditional IRA and pulled out $20,000 to cover the property taxes and the new higher Medicare costs. But remember, Eleanor is over the age of 73. Under Internal Revenue Code Section 401A-9, she is subject to something called RMDs, Required Minimum Distributions. The government forces you to take money out. Here is where the trap finally closes. Eleanor was so panicked about getting cash that she didn't calculate her RMD correctly based on her end-of-year balances. She just grabbed the cash to stop the bleeding. Under the newly passed Secure Act 2.0, if you fail to take your exact required minimum distribution, or if you calculate it wrong because you were reacting to an emergency, the IRS hits you with an excise tax. Historically, this penalty was a mind-numbing 50%. Can you imagine that? Half of your money gone, just like that. Thanks to Secure 2.0, they've reduced it to 25%, which they think is a favor. But let's be real here. A 25% penalty on your own hard-earned savings is still a massive punitive tax. Eleanor was trying to solve a problem, but she accidentally triggered a third financial landmine. So let's review the carnage of this single bank deposit. One check triggered the provisional income tax on her Social Security. It triggered a 2-year delayed IRMAA penalty that garnished her monthly checks. And her desperate attempt to fix the situation triggered a 25% excise tax penalty because she messed up the RMD sequence. It's a perfect storm of bureaucratic red tape and high-stakes math. The vast majority of retirees in America walk right into this trap with a blindfold on. They trust the system, they trust the bank teller, and they end up paying for it for years. Make sense? But listen to me. I am not here just to terrify you with Eleanor's story. I am here to arm you with the tools to fight back. Because there is a way to neutralize every single one of these. I know Eleanor's story sounds like a horror movie for retirees, but here's the thing. You don't have to be a victim. If you're anticipating a large check, you need a surgical strategy to neutralize this chain reaction. Execution and sequence are everything. If you do these steps out of order, the plan fails. So, let's talk about step 1, the IRMAA Nullification Protocol. If you receive an IRMAA surcharge letter, do not just accept it. The government has a backdoor, a legal appeal process, but they aren't going to hand you the keys. You have to know the exact form to use. Get a pen and write this down. Form SSA-44. This form is titled Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. Most people see that title and think, well, selling a house isn't a life-changing event in the eyes of the law. But here's the secret. The SSA knows that looking back 2 years is a flawed system. If your income dropped because you stopped working, or because of a property loss, or even a divorce, you can file this form to demand a recalculation. If Eleanor had known about Form SSA 44, she could have argued that her income from 2 years ago was a one-time spike and didn't reflect her current financial reality. She could have erased that premium hike entirely. Think of Form SSA 44 as your get-out-of-jail-free card for Medicare. But you have to be precise with your wording. You have to prove that your current MAGI is lower than what the IRS thinks. Now let's move to Step 2, the QCD Firewall. This is probably the single most powerful tool for anyone with a traditional IRA who is facing those mandatory withdrawals I mentioned earlier. Make sense? If you are facing RMDs and you don't actually need the cash to pay for your daily coffee, never take the distribution directly. Instead, you utilize a qualified charitable distribution, or what we call a QCD. Here's how the firewall works. You tell your IRA custodian to send the money straight to a qualified charity. It could be your local church or a nonprofit. The money never touches your personal bank account. Because the money never hits your account, it absolutely does not get added to your adjusted gross income. It bypasses your tax return entirely. This is huge because it keeps your MAGI low and your Social Security tax-free. By using a QCD, you satisfy your RMD requirement for the year, you help a cause you care about, and most importantly, you starve the IRMAA beast. You're essentially making your income invisible to the Medicare surcharge system. It's like building a high-tech shield around your retirement savings. The IRS sees that you fulfilled your obligation, but they can't touch a single penny of it for taxes or surcharges. Does that sound like a win? But wait, there is a third layer to this rescue plan that most financial advisors at the big banks completely ignore. It's the 60-day forgiveness window and the trap of the indirect rollover. Let's break it down. What if the check you received was actually an indirect rollover from an old 401k? You have exactly 60 days to get that money back into a qualified IRA. But here is where the IRS gets really sneaky. The previous company might withhold 20% for taxes before they even send you the check. If you don't replace that 20% out of your own pocket when you roll it over, guess what happens? The IRS classifies that missing 20% as a taxable distribution. Boom. Suddenly, you're right back in the IRMAA and provisional income nightmare all over again. The rule here is simple. Always demand a direct transfer. Never, under any circumstances, let them put the check in your name. You want that money to move from institution to institution behind the scenes, so the IRS never has a chance to flag it as income. Sequence matters. You control your taxable income first by using direct transfers. You deploy the QCDs second to lower your MAGI, and you appeal any unfair Medicare hikes with the SSA 44 third. That is the protocol. If you follow this sequence, you aren't just reacting to the system, you are outmaneuvering it. You are taking the power back from the bureaucrats and keeping your hard-earned money where it belongs, in your pocket. Listen, I need to tell you something that might be a little uncomfortable to hear. The systemic truth of the American financial system is that it isn't actually broken. In fact, it is working exactly as it was designed to work. The IRS, the Social Security Administration, and the Federal Tax Code, they aren't built to be your financial guardians. They are built to collect revenue as efficiently as possible. And the most efficient way to collect revenue? It's to capitalize on what you don't know. They rely on the fact that you won't notice the interplay between a house sale today and a Medicare premium hike 2 years from now. They bank on your silence. Think about that bank teller who smiled at Eleanor. They weren't being malicious, they just didn't know. The bank's job ends the moment the check clears. The government's job begins the moment you trip that wiretap. In this system, ignorance is no longer an excuse. It is a massive, high-interest liability. But because you've watched this far, you're already ahead of 90% of the population. You have the blueprint. You have the weapons. So, here is your emergency protection checklist to run through right now. First, look at your tax returns from 2 years ago. Does that MAGI number look like a mountain or a valley? If it's a mountain, expect a letter. Second, if you're about to receive a large payout, do not let that check touch your personal name. Demand a direct transfer. Talk to your CPA about moving that money into a tax-sheltered environment before it hits the wiretap. Third, check in on your parents. Seriously. Ask them if they've received any weird letters from the Social Security Administration lately. Most seniors are too proud or too confused to ask for help when their checks start shrinking. You need to be the one who knows about Form SSA 44. You need to be the one who explains how a QCD can protect their IRA from the Secure Act penalties. You are now the family's financial first responder. The strategy we discussed today, the QCD Firewall, the IRMAA Nullification, the Direct Transfer Protocol, these aren't just tips. They are the difference between a dignified retirement and a retirement spent struggling to pay for basic utilities. Don't let your family's legacy be dismantled by a few lines of obscure tax code. The wealth you've built over 40 years can be drained in 40 months if you aren't paying attention to the sequence of events. Now, if this masterclass opened your eyes, do me a huge favor. Hit that like button. It tells the YouTube algorithm that this isn't just another finance video. It's a warning that seniors across the country desperately need to see. And share this. Send it to your parents, your aunts, your uncles, or that friend who just sold their business. You might literally save them tens of thousands of dollars with a single share click. That's real impact. Also, make sure you're subscribed. Next week, we're going even deeper into a massive loophole the IRS is currently trying to close, one that involves inherited IRAs and the 10-year rule. You do not want to miss that. The system is complex, but it's not invincible. Once you know the rules of the game, you can finally stop playing defense and start playing offense. Stay vigilant, protect your hard-earned wealth, and I'll see you in the next one.